If you're a CEO, CFO, or a business owner, or a corporate treasurer like myself, operating in global markets and facing challenges with cross-country, cross-currency payments, facing challenges in securing foreign currency, especially in regions like Africa, Middle East, and Latin America, this episode is for you. Today, we discuss with my guest the challenges and how stablecoins can potentially tackle them. I am Mohammed Kurtam, and this is the Mia Treasurer podcast. Thank you, Nick, for joining me for the podcast.
It's a pleasure.
So let's start with a little bit of intro for yourself.
Yep.
What's your past experience and what path you took to reach here?
Of course, thank you. So my name is Nick Philpott. I'm one of the co-founders of a company called Zodia Markets. Zodia Markets is a digital asset match principal brokerage or a digital asset finance company that is majority owned by Standard Chartered Bank. For those of your audience who don't necessarily have the background on Standard Chartered, so it's a British-based bank, specializes in emerging markets, so particularly in Asia, Africa, and the Middle East. It's about 200 years old, and I worked there for 16 years, most of it in what we call financial markets, so sort of the trading part of the business, lots of screens, lots of shouting, trading floors, all those sorts of things. So I had a variety of roles, started out in the graduate program, spent some time here in Dubai, did 6 months of training here in the office over in DIFC. And then my first permanent job was over in Standard Chartered Lagos in Nigeria, where I was on the trading floor covering local financial institutions on the sales side. Back to the UK, worked in the COO function for many years in foreign exchange. Over to Singapore. This is all sort of fairly standard for a Standard Chartered, sort of not quite lifer, but certainly having done such a long innings. Singapore, did a few more asset classes. Back to the UK to work in regs, and then finished up in the electronic trading division. That in turn, maybe we'll go into this a bit later, but led to me meeting the team in SC Ventures, which is the ventures arm of Standard Chartered. And one thing led to another, and we founded Zodia Markets in April 2021, commercially launched in September 2022.
So you started a career in SCB and spent
Correct.
mainly most of your career in SCB until
Yep.
you joined the SC Ventures and
Yep.
then created Zodia Markets.
That's exactly it.
And you mentioned that you went to Nigeria. You spent some time
Yep.
from your career in Nigeria. How
Yeah.
long was that?
So that was 2009 to 2010. So a little bit over a year.
Okay.
Lived in Lagos, lived in Ikoyi and worked in Victoria Island. And I suppose that gave me exposure to a serious developing market where fundamental infrastructure doesn't work in many cases. So a simple illustration, if you take clients out or customers out for entertainment, then back then the telecommunication system couldn't support Visa or MasterCard. It just wasn't able to carry the messages. So instead, you have to pay with cash. Now, unfortunately, back then, it might be the same now, the biggest banknote in Nigeria is the 500 naira note, which is about £4 or £5, I suppose, about $5. So you need quite a lot of them in order to pay the bill. So rather than bringing a card machine, they'd bring a money counter to the end of the table. So you'd be sitting there like Tony Montana from Scarface with, But that left a very visceral memory of what it's like to be in a place where the financial system just doesn't operate as perhaps we're used to here in Dubai, where you can do everything contactless. I mean, when was the last time you used cash here?
Yeah, I don't remember. I mean, it's very rarely you use cash here in UAE. But this is exactly the point. So what I want to go back to is I want to understand why you chose this path. So you were a typical banker. You
Yep.
had very good experience in banking.
Yep.
What triggered you? What was the reason?
Yeah.
Why did you think, okay, no, we need to think differently. We need to find a way to solve some of the challenges we're facing in the trade fight or traditional banking networks.
Yeah.
So what was the trigger for you? Was it the Nigeria trip? Was it something else?
Nigeria certainly has driven me to want to see the financial system improved. So when I used to commute to the airport in Nigeria, I used to drive past a place called Makoko. Makoko is one of those shanty towns that sits on top of the water. It's on stilts. The water is covered in rubbish. Everyone is very, very poor. And to me, that was always a community that had been left behind by the financial system. People that cannot get bank accounts. If you can't get a bank account, then your access to credit is curtailed. So the ability to just run even the most basic of businesses is more or less impossible. And that in turn consigns you to perpetual poverty. So that's, from a visceral sort of emotional perspective, that's what drove me on. Then what triggered it, I suppose, is two different things. You have a trigger in your personal life and a trigger in your professional life, or, two turning points, perhaps. On the personal side, the turning point was because of my younger brother, Chris. So he's a big video gamer. And I remember going round to his apartment in London, which we've still tried to work out when it was. Bitcoin was somewhere between $6 and $11 back then. And I went round to his house to watch a movie. And he puts the movie on, and I can't hear anything that's going on in this movie. It was Apocalypse Now we were watching. I still remember that. Because he had all these computer towers in the corner of the room just whirring away. I said, buddy, can you turn these computers off? I can't hear a word. He goes, no, they're mining Bitcoin. They stay on. I said, what? Then he sat down, got me the white paper. I then read that over the course of the coming weeks. And what he was doing was he was mining Bitcoin and using that to buy spaceships on a video game that he was playing.
If he can know the price now, I mean, he wouldn't have bought the spaceships.
Exactly. Yeah.
In hindsight, I mean,
well, he's kept some. I mean, so he's done well. So anyway, so that was the turning point for me on a personal perspective, and then on a professional perspective. So this is now already public. So I've said this publicly before. In 2019, Standard Chartered met with Facebook, and Facebook they were asking many of their banks for support with Libra, which later became DM, and that percolated through Standard Chartered to two people. One was a gentleman called Max, Frenchman, who set up Zodia Custody, our sister company. More on them later. And the other one was to me. So Max was in the department of the bank that we know as transaction banking. So transaction banking does cash, so you'd be very familiar with that from a treasurer's perspective. They do custody, so if you have US treasuries or bonds or things like that, they're looking after that. So part of that division is called security services. And then I'm on the other end of the spectrum, which is financial markets, which is the trading floors, which is derivatives, which is executing foreign exchange and those sorts of things. Because of my brother's influence, developed a reputation as the sort of crypto bore of the London dealing room. And the two of us were simultaneously asked to go and meet Facebook because the relationship manager didn't know what digital currencies were. Facebook had sort of said, well, we have a special project and all the rest of it. Could you help us? So Max and I met in February 2019 in front of Facebook. They described Libra. Libra was a permissioned, centralized stablecoin. That it was a single multi-currency coin. So they were going to back it almost like an IMF SDR. So special drawing rights. So multiple currencies backing a single token.
So it's not just one currency backing the token. It would be like a basket of currencies.
Exactly. It was a single token backed by a basket of 5 currencies from memory. So mostly dollars, euros, sterling, Swiss, and Singapore dollars. Anyway, so they described that. I vaguely remember mentioning it sounds very similar to something called the Hong Kong linked exchange rate system, which is the way that the Hong Kong dollar is pegged to the US dollar. They asked sort of, what is that? So we wound up writing a paper. And anyway, that was the beginning of the engagement. We worked with them and some other banks for about 2 years. As a bank at Standard Chartered, we learned a huge amount because if you have sort of traditional crypto assets, so Bitcoin or Ethereum or things like that, and you go to a risk manager or a compliance manager and they have no background, and you say, okay, so there's this cryptocurrency. We don't know who created it. It's called Satoshi Nakamoto. We've never heard of them. No one's identified them. And it's incredibly volatile. The risk and compliance guy is going, no, not interested. Whereas if you go to someone and say, it's an asset backed by a basket of currencies, okay, well, we deal with things like that already in traditional finance, and Facebook is doing the technology. Suddenly, the level of concern is significantly diminished, and people will actually sit and listen and hear you out. So it becomes much more of a case of it's not a no, it's a yes, but we need to manage this risk. Yes, but we need to manage that risk, and so on. So that was phenomenal. We worked with them for 2 years. I was the project manager. And so from a professional perspective, for me, that was my entry into crypto assets and digital assets.
Okay, well, I think that takes us to the next question is, what sort of challenges are there in the traditional banking network?
Mm-hmm.
that would trigger us to look into solutions like the stablecoin.
Yeah.
So let's go through the challenges in terms of costs,
Yep.
time,
Yep.
regulations.
Yep. Okay. So I think if we step back, crypto has a problem of or did have a problem, sort of a cult of personality. So Sam Bankman-Fried, Vitalik Buterin, Satoshi Nakamoto, CZ, and so on and so forth. So it's almost gone through that phase. And it has all of this it has its own language, it has its own culture. I would almost say just strip all of that back and try to step back and get a real perspective on what crypto actually is. Crypto, in my opinion, is simply the migration of finance onto the open internet. So if I draw, and this is a path that many other industries have already charted. So to give you a couple of examples, so music. So as you and I were growing up, we had music on cassettes and CDs, maybe mini discs, Walkmans and all those sorts of things. Then the open internet arrives in the mid 1990s, late 1990s, maybe we started using Napster. Napster is almost the sort of pirate type phase that crypto has gone through maybe over the course of the last 5 or 10 years. So questionable legality, certainly no regulations. That's sort of patently obvious, or at least not in sort of major financial centers. Napster has then progressed into iTunes, Spotify, much larger companies, clearly regulated. The intellectual property is managed. Certainly, it's created winners and losers, and that's subject for perfect valid debate within society. But it's that migration onto the open internet that now you no longer have those physical CDs.
Like the video VCs and Netflix now, for example.
That's
100%.
another great one. Journalism will be another. You've gone from physical newspapers, but it also changes markets. So in the UK, say you have the Financial Times, the Telegraph, the Sun, all competing with each other. Suddenly you put it on the open internet, and they're competing not only with the Wall Street Journal, the South China Morning Post,
with Twitter now.
exactly. Yeah. And then you're also creating new market entrants, and you're demolishing whole business models. So you've got to quickly reinvent yourself. So this migration to the internet creates winners and losers, and I think the same is true of finance. I think the challenge is that finance is finally starting to go through that migration, and that's really what crypto is. So then, if we look at what's it migrating from, the banking system. I mean, the biggest part of it is called the correspondent banking system. All right. Now, why is that structured the way it's structured? When we move money in a particular country, you're usually doing it across a government or a central bank, some cases a private sector, but generally a centralized payment system. So if I look at the United States, the wholesale system is called Fedwire. It traces its origins back to the 1910s. When it was literally telegraph. That's where TT, telegraphic transfer, comes from. In the UK, you've got CHAPS and so on. You've got different types of systems as well. So UK, you've got CHAPS, which is doing wholesale payments, which are unlimited in size, which is whatever you can fund, but it is limited in terms of operating hours. And those systems are closed at weekends, and they're closed on national holidays, which is where, certainly in the UK, you get the phrase bank holiday. The banks are closed, but now in the modern era, those payment systems are also closed. Then you've got sort of more retail faster payment systems. So the UK, it's literally called FPS, the faster payment system. And what that is, and as the name implies, a very fast payment system that doesn't have cutoff times. It operates 24/7, but it's usually capped. So in the UK, it's capped at £25,000 per transaction. For retail, and I think wholesale is much bigger. It's like £1 million or something along those lines. So you have these different systems. Now, each country has its own system. Okay, almost all countries now have their own real-time gross settlement system. A few have check clearing systems. The challenge is that in very rare, with very rare exceptions, those systems don't talk to each other. So if I go back even further, just to try to paint an even more physical analogy. So trading started in the Amsterdam Stock Exchange in the 1600s, late 1500s, early 1600s. And previously, if you were buying and selling shares or you're buying and selling physical goods, you would take physical cash, bags of gold, bags of silver, maybe promissory notes, credit, things like that, and you'd exchange it with each other. that obviously exposes you to quite a lot of risk, mostly of being robbed. So instead, you hold your assets at a secure institution, which will be a bank. The bank will then hold of your assets, but then if you and I are making a trade, we could go and stand in front of our banker and say, I'm buying a ship from Kotam, so can you just take my balance and move it to Kotam's balance? And the bank will go, absolutely fine. So you and I have not had to physically move anything, and we've just gone to a central system, and the central system has transferred from me to you. Those government payment systems are exactly the same. That's you and me communicating with the system saying, please debit my balance and credit Kotam's balance. Does that make sense?
Yeah, it makes sense. I think one of the other things as well that people don't really understand, and when it comes to the payment system, payments, there is a huge difference between settlement and finality.
Mm-hmm.
So when I send money to Nick today, even though he can see it in his account, maybe within 10 minutes, sometimes an hour or so, that doesn't mean that the money actually moved from my bank to his account.
Correct.
The finality is totally different from the settlement. So this is something also that leads us back to the how slow the system is.
Yeah.
And the idea that you mentioned that it's not operating 24 hours, 7 days.
24/7,
Yeah. So these are all drawbacks, plus the costs as well that are also associated with this.
Yeah.
It's very high compared to what we're going to discuss on the stablecoins.
Yeah.
But yeah, these are some of the things that not the typical Joe would know about. Maybe people in the banking sector or treasurers would have an idea. Because these things, in my field of work in treasury, financial transactions costs are one of the major things that we negotiate with banks.
Yeah.
These are not small costs. And these pile up to thousands, and maybe even in huge entities might be millions of dollars a year of transaction costs of payments between one bank to another.
Yeah.
Beside those costs and time-consuming payments delays, we also face issues trying to secure foreign currency. Especially when you operate in regions like Middle East and Africa, Latin America, etc. Can you maybe shed some light on that?
Yeah, sure. Well, we'll start with just what's the root cause, or how do some of those cross-border payments look like today? So let's say, for example, I'm in Singapore and I'm importing rubber from Malaysia. Okay, it's grown in Malaysia, very, very simple. Now, what I would have to do is I go to my bank, let's say I bank in Singapore dollars, and I would say, here are the bank details of the rubber plantation owner. Please pay the rubber guy in Malaysian ringgits, debit my Singapore dollar account and pay him in ringgits. So what's actually happening behind the scenes is my bank then goes, right, there is no liquidity in SGD, Sing dollars, versus MYR, Malaysian rupees. So we have to walk through something that those two currencies overlap. Make a Venn diagram, what's in the middle? Most commonly across the world in the various different currencies, the thing in the middle is the US dollar. In some cases, it's the euro, but generally speaking, it's the US dollar. So what we're going to do is we're going to convert my Sing dollars into US dollars. Then we're going to convert my US dollars into ringgits, and we're going to pay my the plantation owner. Now, how that works, let's say I bank with OUB in Singapore. Unfortunately, OUB, let's pretend, doesn't have what we call a correspondent banking relationship with an American bank, but DBS does, or say Standard Chartered does. So OUB will transfer effectively Sing dollars from its balance to Standard Chartered's balance. Standard Chartered will then do dollar Sing foreign exchange, and it will pass those costs and charges back to my bank, OUB, and ultimately to me. Let's say the dollars then go to Citigroup, which is Standard Chartered Singapore's dollar correspondent. Let's now pretend that Citigroup doesn't have a correspondent banking relationship with Malaysia. So now we go from Citi to JP Morgan, which does. So that's a transfer from Citi to JP Morgan. JP Morgan then does dollar Malaysian ringgit transaction with Maybank, which is a bank in Malaysia. Unfortunately, it's the only bank in Malaysia that I can remember. Anyway, so now you're into ringgits of Maybank, but unfortunately, Maybank isn't the bank of the guy I need to pay. So let's say we go to another Malaysian bank, which is the bank of the guy I need to pay. So what have we got? We've got 2 banks in Singapore, 2 banks in the United States, and 2 banks in Malaysia. How do we move the Singapore dollars, the US dollars, and the Malaysian ringgit? It moves across those wholesale payment systems that I mentioned earlier. The central bank who's going debit, OUB, and credit Standard Chartered, for example. So that payment system in Singapore is called MEPS from memory. So you've got to go across that. Now, MEPS has particular operating hours. So let's say it closes at 3 p.m. Singapore time, and the United States has only just started for the day. The US system is now called FedWire. FedWire now goes round, and then we come to the Malaysian system, which is called, I can't remember, but it's run by the Bank Negara Malaysia. And now Malaysia is an Islamic jurisdiction. Singapore is multi-faith, and the United States runs mostly on a Judeo-Christian calendar, but then has loads of its own holidays. So you have 3 different holiday calendars. So what you're going to go through is you're going to go through 3 different time zones, 6 different banks, 3 different payment systems, none of which speak to each other, 3 different holiday calendars, 3 different sets of operating hours. And so my bank, when they're going, okay, we've got to send this payment, you have very little idea which banks you're going to go through as you progress across that, how long it's going to take. And this is before you get into then, you've got to go through 6 different levels of financial crime screening. So let's say Citi screens the transaction, goes, well, I have no idea who Nick is, and I've never heard of rubber plantations in Malaysia, so we're going to stop the payment. So now a payment almost becomes like placing a bet. Is it going to arrive today? Is it going to arrive tomorrow? And so on. I suppose last but not least, think of it from geographical terms. I'm going from Singapore, then I'm traveling west to the United States. The dollars are clearing there. I'm then going around the world again and arriving in Malaysia. An alternative way I could do this is I could just buy dollars in Singapore, get on my bicycle, and ride to Malaysia. I would probably get there quicker than the correspondent banking system. And if that is an indictment of how funding is done, cross-border payments are done in this world, then I don't know what is. I suppose if that was all quite complicated, and that's quite easy to explain with a whiteboard, but if I make it even simpler, if we ran email the way that we run cross-border payments, I wouldn't be able to send an email after 5 p.m. local time. If I have Hotmail and you have Gmail, I can't email you. If I send you an email, what's today? Friday, then my email won't arrive for 2 business days. So my email arrives on Tuesday. I have to pay 1% transaction fees for every email. Let's say I'm in the UK and you're in Egypt. I can't email you anymore. It's ridiculous. We don't do that in email because that would be insane. But we sit here and we seem to accept that that's acceptable behavior in the 21st century in wholesale cross-border payments. It's madness.
100%. I think the example that you just mentioned, people might think that this is exaggeration. But no, this is something that we face every day.
Correct.
As treasurers.
Yeah.
Operates in countries like Malaysia or Africa, or etc.
Yeah.
This is actually something that we do face each single day.
Correct.
This is not just an hypothetical or 1 in 1,000 transactions. This is a very normal, typical transactions that will take sometimes days, sometimes even weeks to settle a payment between 2 countries.
Yes.
And in addition to the time delay, the cost that's associated with that, because each of these banks, each of these 4 banks will have their costs on and above of this payment, which is what I was just mentioning before about the costs and the transaction costs. And if you go to your bank and tell him, okay, I've sent $1 million from my Singaporean bank to the bank in UK. Why did it cost this much? He will tell you, they will tell you, oh, our fees is just this. All of the other stuff is not us. It's the other banks.
Exactly.
You cannot even negotiate that.
No, quite.
It's just ridiculous.
You're not their customer. The guys in between. It is absolutely ridiculous that we continue to allow things to operate that way. When you speak about cost, I suppose there's a good framework that I use to try to think about costs. 3 different types of costs to anyone. Number 1 is there are explicit costs. So that's just what I'm going to charge you, whether it's FX charges or banking charges or transfer charges. Those are the things I can give you a schedule of fees and you go, yep, fine. I accept. I sign here, off we go. The second are implicit costs. So let's say, for example, you're making that cross-border payment that I just described, Singapore to Malaysia. and it takes 4 days. So in corporate treasury, you have a concept of time of working or time employed of working capital. I forget the exact phrase. So it's how long you have to tie capital up, because that payment will have been done with a deposit at a Singaporean bank. Now, I bet that bank, because it's a demand deposit, it's not paying you any interest. So now that's capital that's just what you have to fund from your shareholders or from your, whoever, or in debt. And that is just sitting dead, unable to be deployed for anything useful, whether it's generating yield or being used as working capital or whatever else. That's just dead funds. So that's an opportunity cost, an implied cost of what you could be doing with it elsewhere. The third, and actually the one that I think global finance, particularly wholesale finance, doesn't appreciate well enough, is the psychological cost, which is the anxiety and the uncertainty. Because more and more these days, particularly with emerging markets and challenging payment corridors, when you make a payment, it feels like you're taking out a bet. As I said earlier, is it going to arrive today? Is it going to arrive tomorrow? You don't know. The analogy I would use is that the London Underground, the metro system that's been around for about 150 years, the best investment in terms of improvement in customer experience per pound invested wasn't making the trains faster or making them cleaner or redeveloping the stations. It was the screens that tell you when the train is going to arrive. And the reason for that, which incidentally Uber discovered as well, and I'll go into that in a second, is that 3 minutes of unknown waiting time is more uncomfortable than 10 minutes of known waiting time. Uber has this with their map. So the Uber map doesn't make the taxi any faster, doesn't make it any cheaper. Other parts of the Uber system maybe do that, but that doesn't make any change. What it does is it addresses your anxiety. Say, for example, you've got to get a flight and you've phoned a taxi and you've said, please be here today to take me to the airport. You wind up in the old days standing at your front window going, where is it? Where is it? I hope it's coming. Oh my God, am I going to be late? Whereas you can look at the Uber map, go, okay, he's 10 minutes away. I can make a coffee. I can chill out. I can finish packing. And I don't have to panic. It's reducing that psychological cost that I think that treasurers often underappreciate.
100%. I think when you said that, this reminds me of a payment that we had to do to one supplier, which got delayed. Without going into details, but it was because of the typical payment systems that we have now.
Yeah.
Obviously, there was a damage that happened between the relationship between us and the supplier. That's number one. Number two, the second shipment that he did, he added costs.
Right.
Because he said, okay, the money it literally took 1 month for the money to reach them.
Wow.
So the money took 1 month to reach the supplier.
Yeah.
So he said that in the next shipment, I'm going to add additional costs, which is interest on the amount of the previous payment to the new shipment.
Yeah.
Which is something that we couldn't negotiate.
Yeah.
It wasn't our fault.
Yeah.
We didn't delay the payment.
Yeah.
And the money was debited from our account on day one.
Yep.
So we didn't have the money. We lost the interest that we could have earned on this money.
Yep.
We damaged the relationship with the supplier.
Yeah.
And we incurred additional costs in the following shipment.
Yep.
So it's 100%.
You can drop that into each of the categories. So his opportunity cost, that's his implied cost. He's turned that into your explicit cost. He's billing you. Your implied cost, your opportunity cost is obviously increased. And no doubt he's probably taken some of his psychological cost, which is he's dealing with you. He doesn't know if he's going to get paid. So now he's turned that into an explicit cost for you to discourage you from delaying in future, albeit it wasn't you. It was the banks. So, and the weird thing is it's almost a little bit like the banking industry has been accused of this, certainly in 2008, that it's very hard to really pin down who's accountable. And that example I used earlier, there are 6 banks. So who do you put the blame on? You have to sort of pull on the thread and work out where it is to identify where the delay is. And more often than not, it's not a conspiracy. It's usually ineptitude. There's no, what I suppose airlines and other sort of reputationally sensitive industries called sensitivity to shame. That sense that if they do something bad, then you can take your custom elsewhere. In some of these payment corridors, there's nowhere else to go. I suppose the difference also with airlines is they make their members of staff sit at the front of the airplane. So if it crashes, they get hit first. So
I think one more thing that we might look into when it comes to the challenges facing the current banking network
Yeah.
is the split between the
Yeah.
messaging system with the Swift,
Yep.
and the payment system. A lot of people get confused and they think that Swift is the payment system.
Yes.
No,
Yes.
Swift
Correct.
is just messaging system.
That's
so
right.
when you do a payment,
Yep.
when you have the Swift, that doesn't mean that the payment went.
Yes.
It's just
correct.
a messaging system
That's right.
that basically the banks use
Yeah.
to communicate between each other and saying, okay, you should expect this payment coming
Yep.
from my end to your end.
Yeah.
And if there is a bank in the middle, a corresponding bank, then
Yep.
there will be multiple Swift messages.
Exactly.
One of the issues that I face in Africa specifically,
Yeah.
that you would receive a Swift message,
Mhm.
but the payment doesn't go.
Correct.
When you communicate with the receiving bank,
Yeah.
they will tell you, no, we
Yeah.
have not received the payment.
Yeah.
Until you receive if I remember correctly, it's called the UTO, or the unique transaction number, UTN.
Oh yeah. Yeah. UTN. Yeah.
Yeah.
Yep.
You have that Swift,
Mhm.
but you cannot prove that the payment went.
Yeah. Correct. Correct. Well, you don't know the notional either necessarily. So no, you're absolutely right. So that's often a misconception. So SWIFT, Society for World International Financial Transfers, from memory, something like that. It's created in the 1970s, consortium of banks. It's based in Luxembourg, if I remember rightly, somewhere like. So it's in Europe, might be Belgium. And as you say, it's a messaging system. It's not actually moving any money; it's moving information. Now, it's obviously become more sophisticated over the years. They now have things like Swift GPI, so the Global Payments Indicator or Identifier, I can't remember, something along those lines, but tries to bring some transparency to that cross-border payment where I said you had 6 different banks. So at least you could tell which bank it's in. Nevertheless, that still leaves you in a quandary. So let's say, for example, Wells Fargo, Citi, I can't remember the banks I used, Citi and JP Morgan. So let's say Citi see a red flag in the transaction, and maybe they're just not comfortable with Malaysian risk. So they freeze the transaction. Now, there's a concept there of not being able to tip off why the transaction has been put on hold. So that's actually a financial regulation. They're doing the right thing. That's what they've been told to do while they investigate the payment. The problem that creates is you are a client of OUB. So you can go to OUB in Singapore and go, where's my payment? And they go, well, we'll ask Wells Fargo. Well, Wells Fargo can't tell them why they're investigating your payment. So no information comes to you. If you phone, not Wells Fargo, if you phone Citi, then Citi won't respond to your inquiry anyway because you're not their client.
You're not their client.
And they can't tip off. So it just places you in this catch-22 situation where your money is just stuck. I was talking to someone at a fintech company today, and they had one of their seed investors sent them funds, and the funds were stopped for a month. So they had to go and literally either get the seed investor to send another set of funds, or they actually wound up having to effectively restart the raise to fill in the gap. It's that level of inconvenience that something quite trivial creates.
Yeah, the disconnection between the messaging system and the actual payment, and you have a message that tells you that the payment was done while the payment was not done.
Yeah.
And there might be some investigations going behind that. You have no idea what's happening.
Yes.
The lack of clarity.
Yes.
Just to simply put it, it's a lack of clarity.
Yeah,
right?
exactly.
You would expect from a system that is that sophisticated to have clarity and transparency.
Yeah.
But it ends up being actually totally the opposite.
Yeah.
It's very frustrating.
Well, there's 2 ways of fixing it. And you should arguably do both. You should either do the hardcore bit, which is the physics, just make it faster, and or the second part, which is that the Uber map example. So make it more transparent. So either just make it quicker or make it something that creates less anxiety. Those are the 2 things the industry needs to do.
So that takes us to stablecoins. But before we jump into how stablecoins would solve or maybe help potentially solve some of these or tackle some of these problems or challenges, let's first define stablecoins. What are stablecoins? How do they operate?
Okay. Well, let's start very briefly on just blockchains as well. So blockchains has a very long history, actually. The various different technologies that went together to make blockchains. I mean, fundamentally, it's 5 technologies. Linked timestamping, Merkle trees, which is effectively a way of taking transactions, batching them up. The third is consensus mechanisms. So just think of that as an election or a vote. The fourth is hashing, which we use in email and things like that, which is a way of compressing data effectively. And also, it's almost like a barcode for data in a sense. Barcode, something that's standardized, the same length all the time, and it's a way of identifying something. And then the fourth is, again, something that we use throughout information technology. Is how internet banking works, which is public-private key cryptography. So what Satoshi Nakamoto did, creator of Bitcoin, is took those 5 technologies, put them together, created Bitcoin. But fundamentally, what they created was a distributed ledger. So people might have heard of DLT, distributed ledger technology. Effectively, all that is creating a ledger that shows balances, so who owns what, and transactions. So those are the transactions that led to the situation we have now, which is who owns what. Now, those blockchains have a couple of different qualities. So the first is, they might be, there'd be something called immutable. So that means that you can add new transactions. Think of that in a treasury perspective as adding new cash flows to create new balances. Okay, so I give funds to you. That's a cash flow. My balance has gone down. Your balance has gone up. Immutable means that we can add more transactions, so we can change. We can move into the future. What we cannot do is go back into the past and change transactions that have happened, and by extension, change balances in the past, or critically, the balance now. Who owns what now? So it needs to be immutable. The second is it needs to be secure, because if you have a blockchain that's trying to secure assets and they're either very, very easy to lose or very easy to be stolen, then the assets won't retain their value. Okay. Now, something like Bitcoin is obviously now very valuable, so hacking attacks and things like that happen a lot. So you want to make sure that the assets are very secure. And the last part is that it needs to be reliable. So you need to be able to rely on the fact that what you see, who owns what, is trustworthy and reliable. But critically, you don't want to go to a huge amount of effort to verify that it's reliable, because otherwise that's counterproductive. So you want to try to make this system as efficient as possible. So those are blockchains, put pretty simply. Effectively, just think of it as a way of creating digital scarcity on the open internet. Just very quickly on digital scarcity. Let's say I have a Bitcoin. People would think, well, Bitcoin is digital. Copy, paste. Now I have 2 Bitcoin. Obviously, that's not how it would work, because the Bitcoin would have no value. So you have to make something digitally scarce. You have to make it unique. That creates digital scarcity, and that means that it retains its value, in addition to obviously it being secure and immune to being lost and stolen too easily. That digital scarcity can be applied to any asset. So a treasury, Bitcoin, Ethereum, tokenized real estate, or with stablecoins, tokenized cash. Okay.
Sorry, it's not a scarcity, it's immutability, right? It's like it's non-fungible. It's not about the scarcity. I mean, for the stablecoins, for example, when we're going to discuss, it's not scarce in the sense that there's a limited amount of stablecoins, because you can always create more stablecoins when you have the backing for it.
That's right.
But it is immutable in a sense that once you create one stablecoin, it's just one. You don't have multiple of the same stablecoin. It's non-fundable.
Effectively, if you have a digital asset, you just want to get to a situation where you can't copy and paste it and create more digital assets and go,
exactly.
Well, I've gone from having $1 to $2 with no effort. You've got to have a way of making sure that it stays at 1, because if you can just hack the system and just make it infinitely replicable, so you can replicate it many times, then whatever you have just won't retain its value. So it's got to be scarce in the sense that 1 is 1 is 1 is 1, and that can't be changed. So a stablecoin effectively takes $1 and those or any other fiat currency, and those fiat currencies, as we said earlier, those exist on those government payment systems which are run by central banks or treasuries.
Sorry, before we move to the stablecoin, so just to sum up the blockchain network definition. So basically, it's a ledger that shows the balances of each person. Right? And the transactions that happen between one person to another.
Yep. And that could be legal person or natural
Yeah.
person. Yep.
It's very transparent because anyone can access the network and see what transactions happen and see
Correct.
the balances of each and every wallet, if I
Correct.
might call it that.
Yes.
And the good thing about it is that you cannot go back and change a transaction. What's done, it's done.
Yeah.
Which takes us back versus the transfers of the normal banking system.
Yeah.
Finality in the case of blockchain network is final and it's quicker.
Yeah.
It's done right away and there is no way to reverse it.
Yes, correct.
Okay.
I could probably explain so there we do a training session that we offer to corporates, and frankly it's a 40-minute training session, so I'm not going to do it all now. I've just back then I've tried to compress it into about 3 minutes, which I don't think I've ever done that before. So hopefully it came across clearly. But immutability I can probably explain in a quick 2 minutes. So linked timestamping is a technology that's been around for quite a while, and it's used for things like land registries, right? So let's say I own a field, okay, a 1 acre field somewhere. I'm going to sell that field to you. So I have a piece of paper that says Nick sells field to Cortan for $100. Now, what we do is we write that on a piece of paper and we write the date and time and the transaction details on that piece of paper. Let's then say you sell that field to Alice, okay, and you sell it for $110. You take your transaction, write that on a piece of paper, and you put it on top of my piece of paper. As you do that, you sign the piece of paper that's going on top, you sign the piece of paper below it, and you timestamp the piece of paper that's going on top. Alice sells to Bob another piece of paper, and you keep going. And you make this stack of pieces of paper. Let's say I'm a criminal. I want to pretend that I still own the piece of land. So I take my piece of paper out that sold the land. Sorry, let's say you're a criminal, actually. So I need you to be the criminal for the example here. So let's say you're a criminal. So you take the piece of paper out where I sold the land to you, and you put it on top, because that will show that you're still the owner of the acre of land. However, anyone else will be able to come and look at your piece of paper and see the timestamp is out of sequence. The signature doesn't match the piece of paper below. So they can very quickly tell that the transaction that you've tried to move, you've taken from the past and you've tried to put it into the present, is fraudulent. So that's immutability. So seeing that continual sequence or that chain, and this is where the chain in blockchain comes from, that chain of ownership is a way that you prove ownership.
Perfect. So that explains the blockchain technology.
The chain in blockchain.
And network, which the stablecoin is built on that.
Correct.
Let's move to stablecoins.
Yeah, perfect.
What are stablecoins? How are they created? And and then maybe we can discuss the types of them.
No, it makes sense. So stablecoins, they have their origin in something called eCash, which from memory is from the mid to late 1990s. David Chome was one of the creators of that crypto folklore. But in the modern era, the first was really, I believe it was Tether in 2014. Now, the problem that you have in any digital asset business is that cryptocurrencies settle very quickly compared with the payments that we discussed earlier. So something slow like Bitcoin and Ethereum will settle in minutes, okay? Well, Bitcoin, technically, settlement finality, you'd probably want 5 or 6 blocks, so it's probably an hour, but still, it's far better than the 2 days a cross-border payment takes. All the way down to something like Solana, which could be 300 milliseconds, so a third of a second. So it's very, very quick. Now, the problem you have is that, say, for example, you want to buy Bitcoin, right? And you're going to give me dollars and I'm going to give you Bitcoin. The Bitcoin leg is going to settle in an hour. So, but the dollars, we transact on a Friday, they're probably not going to arrive until Tuesday if we're using the cross-border payment system. Excuse me. So we have a problem because I've given you Bitcoin and now I'm exposed to you. I have counterparty credit risk against you, settlement risk. You might go bankrupt between now and Tuesday, in which case I'm not going to get paid. So how do we make the cash go faster? Now, there are various different ways in cash that you can do that, but the way that the crypto industry has solved it is by creating stablecoins. The other driver behind having stablecoin, well, it's 2 drivers beyond this, is number two is that a lot of crypto companies struggle to get access to banking, so they have to find a replacement. And then third, a lot of cryptocurrencies are very volatile. So if you're holding your treasury and you're trading on an exchange and you're holding it in Bitcoin, the problem is that the Bitcoin's very volatile. So the $100 that you have in your treasury could be 120 one day, it could be 70 another day. So it's very hard to manage. So you need something that's more stable. There we go. You can see where we're going to seg into stablecoins. So what you do is you have an issuer of a stablecoin. You give them $1 and they will give you a stablecoin. They take the dollar and they are going to put that into a bank account, and or they're going to invest it in reserve assets. And incidentally, there are different types of stablecoins, but what I'm going to focus on here is what's known as fiat-backed stablecoins. So that's going to go into a bank account and or a money market fund, or they might invest it in government treasuries or reverse repo or something like that. But fundamentally, it's going to be fully backed. Okay.
Fully backed by either fiat, actual cash that you have,
Yep.
or something that is cash equivalent, like treasury or something.
Perfect. Yeah, cash or cash equivalents. Exactly. That's the ideal design. The stablecoin then, like Bitcoin or Ethereum or ETH or things like that, sits on the same chains as the crypto assets that is being used for. The most popular chain in the world for stablecoins is probably Ethereum. I'd say Tron is probably next after that, and then Aptos, Solana, Stellar, and so on.
These are different types of blockchains.
Different types of blockchains, exactly. So now you've got a representation of $1. So you've addressed the fact that you can't get a bank account because you've got something that looks like $1. You've addressed the problem of holding your trading treasury in volatile crypto assets, because now you've got something that is relatively stable. That's the stable and stable coin. And you've got something that will move as quickly as the assets that it's being used to buy and sell. So that was the original use case for stablecoins, and it was overwhelmingly used in crypto trading. So if you're looking on something like Binance or OKX or things like that, these are crypto exchanges, then you may see US dollar versus Bitcoin, but more commonly, you'll probably see more liquidity in USDT, which is Tether, which is the biggest stablecoin in the world in terms of market cap, or USDC, which is Circle, which is number 2 in terms of market cap, against Bitcoin, against Solana, against Ethereum and ETH, and the various different other crypto assets.
Yeah, let's jump into that. What are the types of stable coins that we have in the market, and which ones are used more often, and why?
So the two that so there's fiat-backed stablecoins. There's a concept of something called an asset reference token as well. So that might be something more like gold. So you have gold in a vault, you issue a token that represents it. And again, that's on blockchain and you can move that around freely. Or you might have something that's backed by something different. So you might have something that's backed by crypto. So Terra Luna was an example of this, which was what they call an algorithmic stablecoin. There's a few more now, but I think for the purpose of this conversation, certainly for treasurers, we'll focus on fiat-referenced tokens or fiat-backed stablecoins. Now, in terms of the different design types, it's really just down to the design of the reserve. So what's the backing assets? Is it a money market fund? Is it deposits at a single bank? Is it deposits at multiple banks? Is it deposits at a domestic bank, or is it a foreign bank? Is it treasuries? Is it reverse repo? Is it certificates of deposit? There's whole different sort of
types of backing.
Sort of menu of cash and cash equivalents. There's a lot of equivalents that you can choose from. So it's those design decisions. Then you've got the different currencies. So far, we've managed to find 26 different currencies that have stablecoins somewhere in the ecosystem. But right now, from a market capitalization perspective, 99 point, I don't even know what the point is, 0.7, it's a high number, of market cap is US dollars. So the biggest is Tether. So that's $149 billion. If you just look at the treasuries that they own that back Tether, if Tether was a nation state, they own more treasuries than Germany. They're not far off. They own more than the United Arab Emirates. And their next target to overtake will be South Korea. So they're big. The next one down, and Tether is issued by a non-US entity. So it's issued by an entity based in El Salvador in Central America. So in a way, that's a bit like a euro dollar. Euro dollars are dollars, but just in non-US banks, effectively. Started in 1955 and has been around for many years. Actually, the Middle East was responsible for turbocharging that market in 1974 with the petrodollar. So petrodollars and euro dollars, basically the same thing. The second largest one is Circle. So Circle is issued out of the United States. So the company is mostly in Boston, although I think they're opening a very large office or a very nice office in New York. And their market cap is over 50 billion, like 55, 60, something like that. So it's pretty big. Most of their reserve is in a BlackRock money market, government bond money market fund, about 85% of it, give or take. So fundamentally, Circle is a BlackRock money market fund. Not all of it, but a lot of it. Then there's a big gap, and then there's a bunch of others. So Paxos issue PayPal's coin. They have their own coin. There are various different designs. There's yield-bearing stablecoins as well. And then you're into sort of other currencies and things like that. So Euro probably has the next largest number of stablecoins as a currency. In terms of market cap, the next biggest one, counterintuitively, is probably the Turkish lira. So yeah, we trade quite a lot of Turkish lira stablecoins.
I mean, given the current situation as well with the
it seems
economic stability, instability, if I might say.
Well, yeah. So if many people go, well, that's quite counterintuitive, because why would you want a stable coin against something that's inherently unstable?
Yeah.
So there's quite a good explanation for that. So currencies have cutoff times. So after a certain time, you can't settle Turkish lira because Turkey is closed. So what do? So obviously we've got clients all over the world, Asia, Africa, Middle East. Turkey is a huge export country. So, for example, ships arrive on Saturdays, but if you can't pay for the cargo on a Saturday, then the ship will wait. And guess what? You're renting the ship Saturday and Sunday. For a moderately sized ship, you could pay $50,000 a day. That's quite expensive. This is implicit costs, the thing that I mentioned earlier. So if you use Turkish lira stablecoins, then you know that if your ship happens to arrive on a Saturday or a Sunday or a bank holiday, that you can still pay for the cargo, or if it arrives at night, you can still pay for the cargo, get the cargo off the ship, and the ship owner is not going to bill you for holding up his ship.
I think this takes us to the next question, which is, okay, we've discussed the issues that we face with the traditional banking.
Yeah.
Now, what or how does stablecoins solve or tackle some of these issues? Let's go with the cost, the foreign currency availability, and the speed of doing transactions.
Well, let's go back to that Singapore to Malaysia example that we used earlier. Now, let's say we do it using dollar stablecoins. Okay, let's keep it simple. I have Singapore dollars. I want to buy dollar stablecoins. That's the first step, because I can't go from Sing dollars straight to Malaysian ringgit. Let's just pretend we can't. So I go to a local broker, like Zodia Markets maybe, and I ask them if I can buy dollar stablecoins. We would treat it just like foreign exchange. We try to make the unfamiliar, crypto, stablecoins, all those things. We try to make the unfamiliar familiar. So we treat it just like foreign exchange. We'll onboard you. We do KYC. You sign our terms and conditions. We do operational testing. We share standard settlement instructions. Here are my bank details. Here are my wallet details, which is the crypto equivalent for bank detail. We do a bit of operational testing. Good to go. You then approach us just like in foreign exchange. Can I have a quote? USDC versus SGD. Circle stablecoins versus Singapore dollars. We go, yep, no problem. Here's the quote. Here's the number. You go, I like that quote. Trade done. Great. That's it. From our perspective, it's just like foreign exchange. Our revenue or our profit is in the spread. Okay, we're going to go and hedge that trade somewhere else, and we'll buy low and sell high. So there's no hidden charges. There's no execution charges, all that sort of stuff. It's just done. We then proceed to settlement. So you send Singapore dollars from your bank account to my bank account. I will send USDC stablecoins from my wallet to your wallet. Great. We're halfway there. You will then send USDC to the plantation owner in Malaysia, and then he will go to a local exchange or a local broker and say, I have US dollar stablecoins. Please, can I have Malaysian ringgits? Same thing happens. He gets a quote, likes the quote. executes a trade, and we move to settlement. He gives them USDC, they give him Malaysian ringgits from their bank account to his bank account, done. What you'll have noticed, there was no United States there. From an infrastructure perspective, there was still the United States there because it's a US dollar stablecoin, but you didn't have to wait for the US to open, clear through 2 banks in the US, come all the way around the world, and then move to Malaysia. You went from point to point. You could have done all of that without the US opening at all. So it makes intra-region commerce a lot more efficient. It's effectively just like emailing money. It's really, really quick and efficient.
So it's basically like 3 transactions versus how many in the other one?
Well,
6?
6 intermediaries. It's sort of death by it could be up to 6. Now you might get lucky. You might have a Singaporean bank account banker who has a US correspondent, who has a Malaysian correspondent. So it could be 3 in the correspondent banking system, but you still have to go to America.
And you still have to wait for the working hours.
Yep.
You might find holidays in Singapore that's not aligning with the holidays in Malaysia, not aligning with the holidays in the US.
Yep, exactly. So, if you landed on 4th of July, Singapore is not moving dollars, which is absurd because Singapore doesn't celebrate 4th of July, neither does Malaysia, but they would like to carry on business even though the US is closed for the day. So that sort of ridiculousness can stop. I suppose the other thing in the longer term, though, is if you have a digital representation of a dollar on a blockchain, money, then what else could you put on a blockchain? So let's imagine that you have your cargo. So what was it? Rubber, I think it was. So you have a bill of lading or an invoice that represents the rubber, on the truck, and you could tokenize that. You could digitize it. You could put it on the same blockchain as the means of payment. So what that means is now you could move your cargo or the representation of your cargo at the same time as your money. So you could finally have your cargo or your representation of it and your money talking to each other for the first time.
So what you're saying is we can use the blockchain network, not just to transfer the money in terms of stable coins, but also transfer documents that is backing this payment as documents that is basically the proof of the payment from one party to another on the same network.
Correct.
So they'll be speaking to each other.
Correct.
And like we discussed, the blockchain network, it's immutable, it's very transparent. You can double check and make sure that these are the right documents. So this also takes part of the trade finance that the banks are doing, which also has a cost as well.
Exactly.
And going back to the costs, in the example that you just mentioned, I would assume, but maybe you would give me more details, that the cost associated with this transaction, where the fees that you take to give me the USDC versus the Singaporean dollars, and the fees that the Malaysian bank or the Malaysia partner would take to convert the USDC back to the Malaysian currency. These fees, I would assume, are way less than going through the correspondent banks. And
so the correspondent banking system has to price very wide, because at the point at which you go, hey, can you pay a rubber plantation in Malaysia for me? They may not necessarily know how many banks they've got to go through and what those banks would charge in terms of foreign exchange and processing fees and transfer fees and all those sorts of things. So that's your explicit costs. Whereas from our perspective, it's a principal-to-principal trade. You're coming to me and saying, hey, can I buy stablecoins? Yeah, done. Here you go. Here's the price. You know the price. We're finished. Then you deliver. Now, transferring crypto on a blockchain, you're probably going to look at, I don't know, something like a basis point, probably, in terms of processing fees. Very, very. I mean, it depends on the size of your transaction, but it's going to be tiny. Then on the Malaysian end, it's similar. Your exporter knows who he's dealing with, and it's principal to principal. It's first party to first party. So again, the pricing is much more transparent. So by reducing the number of intermediaries, you can reduce the uncertainty. And so as a result, you can price with much greater certainty, and therefore you can price much more narrowly. From our perspective, we get our foreign exchange pricing from Standard Chartered's foreign exchange desk. So that FX is very good quality. It settles very quickly. And actually, that's the bit that we really focus on, is that, say, Singapore dollar leg, just giving you an example, to make that much faster, and to try to help it keep up with the stablecoin that we're sending to you. That's the explicit cost. Then you've saved implicit cost. So let's say Sing dollars to Sing dollars, local to local, I don't know, take an hour, maybe 2, possibly. If we're on the same banking network, it's probably going to take minutes. So that's minutes. Now you're into your stablecoins. You move your stablecoins to Malaysia. That's going to take you minutes. It's certainly not going to take you more than an hour. And then Malaysia to Malaysia local, you could be done end to end in a day. So now we move on to implicit costs. So what was the cost of the correspondent banking solution? It's putting a Singapore dollar deposit with no interest, making a payment and hoping for the best. It might get there tomorrow. It probably won't get there today. It certainly won't get there today because you've got to wait for America to open. So you've got that implicit cost. And if you hit a weekend, you've got another 2 days you've got to wait. So that implicit cost is reduced. And then finally, you've got the psychological cost. When you're doing a stablecoin transaction, you have it much more within your power to make the payment and make it quickly. It's back to the Uber map sort of thing. And also, as we said a little bit earlier on, blockchains are transparent. Now, it doesn't mean that everyone knows who everyone else is, but you know your address, which is your bank account, and if I make an analogy, and you know the address of the exporter that you're sending the stablecoins to. And you can see the transaction go from your address to another. So it's almost like giving you access to not SWIFT, because that's a messaging system, but to the payment,
actual movement of the transaction.
The payment system, exactly.
That's exactly the disconnect that we were discussing earlier between the SWIFT messaging system, the actual transfer.
Yep.
But versus on the blockchain, you can see the actual transaction moving. You can see the movement of the transaction, and correct me if I'm wrong, but you can even see an expectation of how many minutes are remaining for you to for it to hit the
correct
the wallet.
And even more if you're tied in quite well with your wallet provider. Blockchains have a concept called gas fees. So gas fees are basically the transaction charges to process the payment.
Transfer fees.
Yeah, transfer. I could call it a payment because that would probably be more intuitive to understand for a corporate treasurer. Now, in traditional payments, those real-time gross settlement systems, those government systems that move cash, they operate on a first-in, first-out basis. Now, what the banks are doing is they're batching up all of the wholesale payments and they're funding those payments. They're probably doing some netting as well. And then they're putting that through the government system. But fundamentally, it's a first-in, first-out sequential system. Blockchains actually have a bit of a concept of being able to jump the queue. So if you want to pay extra gas fees, then you can incentivize the sort of distributed ledger. I won't go into miners and validators and things. It's probably for another podcast. But you can incentivize the blockchain to settle more quickly. So
by paying extra fees, basically.
Yeah, exactly. You can incentivize the system to settle more quickly. So what I'm almost saying is cash systems, they lack the sophistication that even Soviet bread queues had. If you're queuing for a loaf of bread in Soviet Russia in 1974 or whatever, you could pay a babushka to hold a place in line, and you could pay her and you can jump the queue. Cash payment systems even lack that ability. They're less sophisticated than a Soviet bread queue. There's a headline for you. It's probably a slightly cruel analogy. It probably is. But in blockchains, if you want, you can pay extra. Let's use a kinder analogy. Planes. So we have an accepted sort of societal framework where I'm sitting on a plane, business class is at the front. We're all on the same plane. We're going from the same destination. We'll all get there just as quickly. I mean, they might get off the plane earlier, but we're measuring it in minutes. But I'm quite happy to accept that they've paid a lot more money and they're probably subsidizing my seat. So you can pay more to jump the queue. You can pay more to get off the plane slightly earlier. Everyone's quite comfortable with that because everyone feels, you're sharing the load. In blockchain terms, if you're paying more to incentivize the blockchain, you've actually invested resources in a sense. It winds up making it more secure.
Yeah.
So it makes it harder to attack. Again, that's probably a little bit too technical, but nevertheless, if you want to settle more quickly, and under an hour is still pretty quick, then you can pay extra.
Just having the option there.
Exactly. We've given you choice. We've given you lower costs, both implicit and explicit costs, and we've given you an Uber map. I mean, it's like I don't know how much easier we can make this.
How more transparent can it get? I mean, seriously, this is exactly what we were discussing earlier about the challenges we're facing with the current banking network and payment systems.
Yeah.
Now, let's move to the topic of regulations.
Right.
Because this is something that a lot of the CFOs, CEOs, and business owners would challenge.
Yeah.
And it's something that I have been facing challenges as well to try and explain and ease it to them.
Yeah.
Because there is a misconception or a reputation for crypto
Mhm.
being used for money laundering
Yep.
and all of this.
Terrorist financing.
And the idea is it's actually the opposite from my opinion, because as we just explained, the blockchain is very transparent.
Yeah.
You can know who sent what, at least the address. You know which address sent how much
Yeah.
to which address and what's the balance of each. It's very transparent. You can go back and you have the ledger. Anyone can access the ledger.
Yep.
So I actually see that this is even more transparent than the current traditional banking system.
Yeah.
But yeah, let's dig further into that.
Yeah.
How safe it is, how transparent it is, and how is it currently regulated in Europe and the US,
Yeah.
etc. Because I'd assume a bank like Standard Chartered Bank will not work in something that is not properly regulated.
Absolutely. And that was a huge part of what we did as an organization to understand and then get comfortable. And the thing that we were really looking for is what are the risks that are different from what we do in a normal day to day? And actually, to a great extent, the compliance, the KYC, know your customer, CDD, client due diligence, the screening, the sanctions compliance, it's all basically the same thing from a conceptual point of view. The only places where we actually found that big deviations in terms of risk is understanding custodians. Custodians in crypto are fundamentally slightly different from what we would understand them in traditional finances. The blockchains, obviously, because that's new, and the coins, the stablecoins. Again, there's an intellectual framework that you can kind of apply to most stablecoins and understand them. As I said, Circle is 85% a BlackRock money market fund. We know how to do credit risk analysis and risk analysis of a 2A7 US government money market fund. That's pretty straightforward. So just in terms of the compliance and risk side, so we use the same KYC and CDD standards and policies as Standard Chartered Bank. No deviation whatsoever. So if you want to onboard, we only deal with legal entities, then we do the usual stuff. We ask you for a certificate of incorporation. We ask you for proof of address. We'll probably unwrap your UBOs, your ultimate business owners, whether those are legal entities or natural persons. We'll probably want proofs of ID and address of your directors. We'll name screen your directors and so on and so on and so on. It's all the usual sort of bank stuff. What we've done is we've established your real world identity. We know who you are. Then we look at sanctions compliance. So we could look at sanctions lists. You know, are you a known money launderer? Are you knowingly engaged in terrorism or illicit finance, or heaven knows, or are you from a nation state like North Korea that we can't deal with, and so on and so forth. Similarly, we do geofencing. So if you're coming at us from an IP address in North Korea, then we'll pick that up. And again, that's something that we'll be aware of, and so on and so forth. Where we start to deviate slightly from traditional finance, and I would say deviation in terms of we're adding more. So you have an on-chain identity, legal entity or natural person, doesn't matter, which is that address that we spoke about. Your address, if I put it in blockchain terms or crypto terms, is a hash of your public key address. Again, for a different podcast, but fundamentally, it's a great big long number. Think of it like a giant bank account number, okay, that only you have. Now,
like the IBAN, for example.
Like an IBAN, exactly. Yeah. So what we can do is we can tie your real-world identity to your on-chain identity, so we can bring the two together. What does that allow us to do? It allows us to look at your wallet, and we can see the balances in it, and then we can see every transaction that it's ever done. Now, we see the blockchain, almost think of it as a starry sky, a constellation of addresses. And our crypto is not anonymous. It's pseudonymous. So we didn't necessarily know who was behind your address until you said, that's my address. And then we know your identity and we can tie the two of you together. Now, there are private sector firms in crypto, Chainalysis, Elliptic, TRM Labs. And what they do is they're trying to map out the blockchain. They're trying to identify or put names against that constellation of addresses. So say, for example, you have a ransomware website. Hi, I've managed to lock you out of your system. Please send me a load of Bitcoin to this address. So someone like Chainalysis or TRM Labs or Elliptic will take that address and go, that address goes on a list. That's a bad address. Okay. When we are looking at your address, we can see if you've ever done a transaction with one of those bad addresses that's associated with terrorism, illicit finance, ransomware. We would tend to look for the number of hops or the number of transactions, this sort of 6 degrees of separation, if you like. There's that parlor game you can all work out that we're all related to Kevin Bacon, I think it is. If I remember, you play that at on holidays. So you've got the 6 degrees of separation, and that's sort of the distance that we would look to make sure that you're away from anything that we know that was illicit. So that's your address. Then, secondly, as we start our business relationship, if you're buying foreign currency from me, you're buying Sing dollars or Hong Kong dollars or euro or yen or whatever, you're sending me crypto. It could be Bitcoin, could be stablecoins. Every time that lands, my wallet provider or me is screening those coins as well. So think of it as I've screened your bank account and I'm screening any money that you send to me. And I can see if those coins have passed through a wallet that's associated with illicit finance. Mm. If your wallet has done anything bad, then we won't start a business relationship with you. We'll probably file a suspicious activity report with the regulators. We can't tip you off, all of that stuff. And then the same applies if we get some coins that have clearly gone through a wallet that's associated with illicit finance. Now, in terms of sanctions, actually, it's probably even better. When we onboard you, we'll have screened Botan Mohammed, we'll have screened your company, Cortam Industries, LLC or whatever, against OFAC and the United Nations and the UK and the EU, the various different sanctions lists. If you go and look at their sanction lists on the crypto side, they list addresses. So it's far more precise because, I could open a relationship with you and you just go, actually, I'm not Cortam Mohammed Industries, I'm just KM Industries. So maybe that doesn't map to a list of sanctioned entities. I'm sort of just drawing silly illustrations, but hopefully this makes sense. Whereas on the sanctions lists for crypto, it's a list of addresses. It's like they're giving me a list of your bank account numbers. So if I get a positive hit on your bank account number, right, we're an investigation starting and I'm reporting it to the authorities. So the level of precision is much greater. Let me just try to draw a slightly ridiculous analogy if we did that in traditional finance. You on board with me, you give me your bank account details. Let's say you bank with BankFab, First Abu Dhabi Bank. So what I will then do is I now know your balance. So I've been able to log into your bank account, which is ridiculous. I would never be able to do that in traditional finance. But in crypto, that's what I've just done, figuratively speaking. I've then subpoenaed Fab for every single one of your transactions that you've ever done, ever. I can then see every bank account that you've ever dealt with. I then subpoena all of those banks and I get every transaction they've ever done. And I can continue that recursively all the way back to the beginning of money. That doesn't exist in fiat.
No way you can do that with the traditional banks.
No chance. Absolutely no chance.
So basically, the blockchain gives you a way to be able to know beforehand, before you start onboarding a client, just by getting their address. I come to you, I tell you, this is my address. This is basically my wallet, and this is the number of my wallet.
Correct.
From that, you can know all of the other addresses that I have been transacting with since the beginning of time. Right? And if any of these addresses or these accounts or these wallets has done any solicit activities or was sanctioned, right away you can block relationship with me. You can even report me for suspicious activities. That's amazing.
It is, yeah.
So what comes the idea of crypto is used for?
Well, it's because, frankly, a lot of people don't do their homework. And, this is not, this is my job. I do this professionally. So you would hope that I understand what I'm talking about. So many treasurers can be forgiven for not understanding how this works because it's not their job, right? So that's fine. That's what podcasts like this are for. So they're going on the headlines. Now, the journalists often don't understand how this stuff works. Critically, criminals don't understand how this works. So a lot of people think that blockchains are anonymous, both treasurers, both man on the street, but also criminals. They all thought, oh, blockchains are anonymous, so I can just use Bitcoin or I can use Ethereum or stablecoins, and I'm never going to get caught. The problem is that history. So if I give you an example, in 2016, an exchange called Bitfinex was hacked, and it was it's about 120,000 Bitcoin was stolen. So at the peak market cap of the stolen assets, it was about 2.5 billion US dollars. And the private sector companies, Chainalysis, Elliptic, TRM Labs, were able to track those funds as they moved. Now, they don't necessarily know who controlled those addresses, but they could see it moving. And it stayed in crypto. It went from one crypto asset to another, to one Bitcoin address to another, and it moved around. The natural act of someone trying to launder the money. And they couldn't work out who it was. Fast forward to, I think it was 2023. So what are we looking at? 4, 5, 6, 7 years. 6 or 7 years. And a guy goes to a bullion dealer, I think it was in San Francisco, it's a good test of my memory now, and tried to buy gold with Bitcoin. Now, a bullion dealer is a regulated activity in the state of California or wherever he was. So it probably had a money transmitter license or an MSB license or whatever. So they have to do KYC. So you have to give your driving license or some other proof of ID. So the guy gives the proof of ID, so gives the Bitcoin to the bullion dealer, takes gold and walks out the door. He was arrested 2 days later because the moment that regulated bullion dealer did the transaction, he's obviously able to see, this is linked to illicit finance. I know that Chainalysis, Elliptic, TRM Labs, and whoever has got this on a watch list. I've got a photocopy of the guy's ID that goes to the FBI or the US Marshal Service, and a husband and wife team were arrested 2 days later. It might even have been quicker. It was certainly within 2 days. And now they're in, I think they're in prison or going to prison for a long time. By the time they were caught, so 6 years, any guesses of $2.5 billion, how much they were able to launder?
I'd say half of it.
100 grand.
Only?
Give or take 100 grand.
No way.
They were using Walmart gift cards, if I remember rightly. Don't take
I think this one was done Netflix documentary for this one.
Is it the Dizzy?
I saw one.
The rapping lady. I can't remember her name now.
She was silly, and everyone thought she was just someone who's silly who would never pull something like that off. Yeah, I saw the documentary.
Exactly. It was Ilya Reshtenstein.
It
was a Russian surname for the guy, Ilya something.
Yeah.
She had.
And his father was a con artist as well.
I didn't know that bit.
It's mentioned in the Netflix documentary.
Bitcoin's been seized, and so a lot of these criminals didn't realize that crypto is traceable. So there's a great podcast, Darknet Diaries, and it goes into it's basically a hackers podcast series. I love it, but it tells. I mean, I'm a father of two young children now, and it tells to me a very sad but a positive story of a paedophile network that was using crypto, and this paedophile network was global, and it was selling images, and tried to, for crypto. And because they were all using crypto, the police in various different countries were able to cooperate. They were able to trace all the addresses, and they were able to do I believe it was one of the biggest simultaneous arrests of paedophiles in history. Do go. I can't remember the name of the episode, but do go and check that out. I mean, like I said, it brought me to tears. I think the culprit was actually in South Korea, fairly young man in South Korea. He's now arrested and hopefully doing a very, very long time in prison. But being able to do this sort of analysis is very beneficial compared with the analog banking system, and that's before we get to cash. Cash is completely untraceable. For example, I vaguely remember a story. There was a UK government inquiry. The Bank of England cannot trace something like £20 billion worth of cash, which if you work it out physically, if it's just £50 notes, which is the highest denomination banknote you can have in the UK, it's like 15 industrial pallets of cash to your height. That's an astonishing amount of money. And that's before you go to the euro. The biggest euro is 100 euros. So, what on earth is that for? You can't trace cash.
Yeah.
The country in the world that has the second largest holding of US dollar bills, Argentina. Now, that's not illicit finance necessarily. That's just Argentinians putting literally physical banknotes under the mattress because the local currency has a long history of not working. But the ability to trace blockchains, I believe, presents an opportunity to be one of the biggest allies in fighting illicit finance that we've ever seen.
Yeah, it's basically saying that if you're planning to do something funny, the last thing you want to use is crypto.
Yeah, exactly. There was a deputy director of the FBI who I believe referred to it, a criminal using crypto as a call option on a conviction. It's just time. We'll get to you.
But this gives me, this is actually very appealing because when you think about that, if we decide, if I'm a company, I'm operating in multiple countries,
Yep.
and I have customers in multiple countries,
Yep.
especially in a region like Africa, where I operate, this actually would make sure that I'm also safe in a sense that if I'm receiving USDC or USDT from my customers, I know that they have been screened. And if someone from my customers is doing something funny, I would know.
And if you don't trust your providers, you can do it yourself. You can go and Chainalysis is
I can go to the blockchain and just
you can even do it yourself. Yeah, you can. There are various publicly available software. You can Google them and you can do it DIY. Or if you want, you can call in someone from the private sector, Chainalysis, TRM Labs, Elliptic, the three that immediately spring to mind. There are various other, Arkham Labs, I think is another one. So they can come in and further supplement your anti-money laundering controls if you want that extra.
They come in and actually analyze your transactions and say if I'm dealing with one of the addresses that is flagged or anything. And then I would know that this customer is doing funny business and I can stop the business with this customer or with the supplier.
And they'd probably be delighted because you could actually say, see these addresses? These are my addresses. And they go, great, okay, I can now color in another bit more of the chain. And I know this bit is you guys. You're trustworthy, and you're doing things in a clean way. One other, I suppose, interesting thing is once assets have been seized. So, for example, we know of a company that specializes in seized assets and then goes to the courts, gets they're now seized proceeds of crime. You can auction them off. And we'll literally go to the private sector chains with the court order and go, right, see these coins? They're now clean. These are the addresses that you can go, well, they've gone from a terrible score to a clean score, out it goes. So literally you can clean the assets and get them back out into the ecosystem. But that's KYC AML. We had regulation as well very briefly. So I think a lot of smaller offshore financial centers were some of the first movers in terms of crypto regulations. So places like Mauritius, I think Malta as well, the Cayman Islands, Bermuda, a lot of the first movers. If you start to move to major financial centers, the United Arab Emirates, so particularly Abu Dhabi Global Markets, was the first in this region, as far as I'm aware, to have regulations. Singapore was well up there as well. And then you've had other jurisdictions follow on. So the European Union with a regulation called MiCA, and AMLD5, which is an anti-money laundering directive, Hong Kong as well. My co-founder is very proud of the fact that he worked with the HKMA, I think it was or the SFC, pardon me, maybe both. Definitely the SFC, the Securities and Futures Commission in Hong Kong, and helped them craft their regulations. And again, it's about looking at what regulations do we have today, how do we retrofit those, and then what gap have we left? If we made a Venn diagram, what's sticking out? What do we need to create new rules around? So stablecoins would be an obvious one. Tokenized securities might be another. The United States, the elephant in the room, is now catching up. The new administration is, I think, much more positive, much more receptive about this industry. And don't get me wrong, this industry is not roses and kittens. It's had its bad actors, it's had its scandals, the cult of personality that I mentioned before. In some ways, it's replayed a lot of the old financial crises that traditional finance has had. FTX looks very much like Refco 2005. The collapse of Voyager Digital looks very similar to the collapse of the Knickerbocker Trust in 1907. The rug pulls like OneCoin, that looks like Gregor McGregor from the 1830s, and the ICO boom and the frauds there. That's the IPO boom of London in 1690. Everything has been done before. We're just doing it at a much more accelerated rate. I suppose one of the frustrations that I have is a lot of regulators tend to look at it from, or stablecoins particularly, from a domestic retail payments use case. Whereas I actually think the ability to improve cross-border payments is actually where the huge opportunity is, particularly on the wholesale side and remittances as well. So guest workers sending funds home, obviously hugely important in this region. So that's the first part. I think the second part is a failure to realize that by virtue of these chains and the assets that sit on them being on the open internet, this is it requires international coordination. It's very, very hard for you to set regulations just for your place and prevent the internet from effectively coming in and impacting your market. So there needs to be, in my opinion, as much coordination between regulators as possible. I suppose that the even more frustrating thing is that in 2020, the G20 agreed that they needed to have an international drive to improve cross-border payments, to improve costs of commerce, improve remittances, and so on and so forth. They have, I think it's 19 different pillars or 19 different things that they're focusing on, work streams, whatever you want to call it. How many times is stablecoins mentioned? 0. So, it'd be great to realize that traditional finance, SWIFT, the correspondent banking system, remittance companies, regulators, they're all working to try to make the world a better place. Crypto and stablecoins have certainly had a different origin story, but organizations such as ourselves, we're trying to do the same thing, just with different tools. So, let us come in and cooperate, and collectively, I think we can improve the experience, certainly for corporate treasurers everywhere.
Let's hope so. I think this is one of the reasons. This is one of the reasons we're doing this podcast because, like I mentioned to you off the podcast, it's not everyone knows stablecoins. Not everyone understands how it works and all the aspects around it, especially when it comes to regulations.
Yeah.
So yeah, hopefully this would be one step towards helping not just corporate treasurers, but even business owners, CEOs, CFOs to understand that there is another alternative that we need to all work together to improve.
Correct.
It's not perfect. Like you said, it's not all roses.
Yeah.
There has been some issues there.
Yeah.
But we need to collaborate to improve it together.
You're absolutely right. And don't I'm obviously very positive and enthusiastic about stablecoins, digital assets, and so on and so forth, but they're not perfect. So USDC, that depegged in March 2023, ironically caused by the collapse of 3 banks that were holding part of the reserve, about 3% of the reserve, but it was made whole and it went back to 1-to-1. So that was an issue. Some blockchains have failed. So Ethereum has failed, depends how you count it, but once or twice in its 10-year history. So about 10 years. Solana has failed many more times. But that's not to suggest that those government payment systems that I mentioned are infallible. So CHAPS, which is the UK system, that failed in 2014. It failed again in 2023. It was August. It was either 2023 or 2024. Fedwire failed in, I'm going to say 2021. RITS, which is the Australian one, that failed for a while in 2022. Target 2, which is the EU one, that failed 5 times in 2022. I mean, guess what? Right, no one's settling euros today. So because the payment system doesn't work. We had a UK bank failure, I think, about a month ago. One of our members of the staff was buying a house. Unfortunately, his payment didn't go through. So unfortunately, he didn't complete on his purchase of his house. So he and his 2 young children and his wife had to move into a hotel for a weekend.
Yeah. Without mentioning names, one of the banks here in UAE, one day, I think this happened last month.
Yeah.
They deducted all the loan installments from their customers twice.
Oh, no.
So if you owe 2,000 dirhams as an installment, for example, they deducted 4,000 dirhams. And he didn't get back the 2,000 that they deducted by mistake till like 6 hours later.
Wow. It just causes mayhem. So what I'm trying to emphasize is I'm not trying to, say anyone's better than anyone else. What we've done is we've got a new set of tools. Those tools bring different types of risks. Those risks can be understood. And it's not the sort of den of thieves and pirates and money launderers that people think. It's actually well-meaning people, hopefully like myself, who are trying to, frankly, make commerce a better place. And I think where corporate treasurers are really going to come into their own is that creativity. A lot of people don't really understand innovation, so they think of innovation as, you know, a guy in a white or a girl in a white coat in a laboratory creating something new, surrounded by sort of bottles and potions and all that sort of stuff. Innovation can just as much be reframing or finding a different use for something that already exists, or it can be taking something or a few things that already exist and combining them and using them to create something new. So I'll give you two very quick examples that I've used this week that I can remember off the top of my head. So first is air conditioning, which we're sitting in this room and enjoying right now. Air conditioning was invented to keep paper dry in paper mills. It was not invented to cool rooms. But obviously some manager came in and went, wow, this factory feels lovely. Put one of those in my house. So that's the first thing. The second one is wheeled luggage. So, you know, which we'll have seen in the airport. Wheeled luggage was the first invention was the furniture coaster. Well, actually, I'm sitting on a wheelie chair, so there's coasters on this chair. That's 1830. Then you have the suitcase, which was invented in 1930. 40 years later, in 1970, an airline pilot took furniture coasters, nailed them to the bottom of his suitcase, and he invented wheeled luggage. So it took, I mean, it depends how you count it, but either 140 or 40 years to take two existing things, put them together, and create something new. What I'm hoping is that corporate treasurers and various others can take a lot of these tools that we've created or introduced, either reframe them and go, well, this would actually work for my use case here, demurrage, you know, delayed payments and all those sorts of things, or take them, put them together with something else like escrow, for example. Escrow is a beautiful use case for stablecoins. Put them together and create something new.
No, I hope so. I'm just cautious of time, but
Sure.
before, I think the last thing that we might want to discuss, which is very important, is I want to know briefly what is Zodia
Right.
and why Zodia. So if me or someone else decided, okay, that's stablecoins, fun,
Yep.
sounds legit,
Yeah.
let's go with that.
Yeah.
Why should I go with Zodia?
So there's two Zodias. There's us and our sister company. So Zodia Markets, that's us, and there's Zodia Custody, our sister company. When we first created the companies, we believed that crypto was doing a bad job of segregating the activities of execution, that's us, Zodia Markets, and custody, which is Zodia Custody. Now, that's just doing what financial services has been doing for hundreds of years, which is managing conflicts of interest, right? Zodia Markets is what we call a matched principal broker. Fundamentally, we're a digital finance company, but the majority of our business is matched principal brokerage. We're majority owned by Standard Chartered. So in a sense, which is a British bank, Asia, Africa, Middle East specialist, international trade specialist. So what you can think of is we're almost a bridge between traditional finance, what you know and use today, and this new asset class, whether it's something sort of relatively exotic like, you know, Solana or Avalanche or things like that, less exotic, Bitcoin, to relatively vanilla, so stablecoins, for example. And what we allow you to do is to trade crypto assets for other crypto assets or fiat currencies for crypto assets. The vast majority of our business is stablecoins versus foreign currencies. Now, at the moment, the accounting fraternity still hasn't really, I don't think, got to grips with crypto assets. It's either dealt with as inventory, in some rare cases, intellectual property and things like that. So it's not ideal. So a lot of treasurers, considering it's something new, say, I want to use stablecoins, but I don't want to have to stick it into my accounting systems or account for it. So you go, well, okay, that's not a problem because it's going to move so quickly. It's going to be in and out before you've done your end of day snap. Okay. So one of the advantages that we have by virtue of being owned by Standard Chartered is we have access to the banking. A lot of those bank accounts have access to local clearing, which is definitionally as fast as you can make cash go in wholesale terms. So I'm talking anything over $1 million, so something for an international corporate. And we're doing it in emerging markets, which is where we currently offer 21 currencies, and I think 15 of them clear. We should be up to 18 of them clearing by the end of the third quarter, and we're increasing the number of currencies that we cover. But as we said right at the beginning, it's those very challenging payment corridors, particularly the ones you operate across, where stablecoins are most in demand, and Standard Chartered happens to operate across a lot of those corridors. So we can enable corporates to safely and soundly and compliant and in a compliant manner get in and out of stablecoins very reliably, and hopefully reduce their explicit costs, their implicit costs, and their psychological costs, put most simply.
Good. Before we close, I want to go through a quick example.
Yep.
Walk me through it.
Okay.
I'm a UAE entity
Yep.
with a subsidiary, let's say in Nigeria, or
Yep.
pick an African country
Nigeria
where
is good.
you.
I used to live there.
Yeah.
So that's easy.
How do we onboard?
Yeah.
Let's not make it say that I have a subsidiary. I do have a customer, for example, that is going to pay me from Nigeria.
Yeah.
And I want to start collecting in USDC because it's taking loads of time. It's costing a lot. Maybe the customer's bank does not have a correspondent bank who directly communicates with my bank here in UAE.
Yeah.
So I want to go with Zodia Markets. I reach out to Nick.
Yeah.
Nick, help me, hook me up.
Yep.
Let's get started. What are the steps and how long it takes? Walk me through it.
So Zodia Markets has an onshore presence here in the UAE, in Abu Dhabi Global Markets. So we have a license here. We have access to dollar banking and dirham banking through Standard Chartered, and by extension, foreign exchange from their FX desks as well. We obviously cover stablecoins from here. Now in Nigeria, we don't have a license to operate. We don't have access to Naira banking. So you're, what were they? They're an importer. Say they're an importer. They're importing bread from you. So they have Naira. They would go to a local broker or a local exchange. I know a few. One of our favorite partners over there is Yellow Card. They would go to Yellow Card and they would buy stablecoins. Then they would send stablecoins from their wallet in Nigeria to your wallet in the United Arab Emirates. Zodia Markets will have onboarded your company. We'll have done KYC. We'll have done CDD. We'll have sanctions screened you. You'll have signed our terms and conditions. And then thirdly, we'll have done operational testing. Here are our bank details. Here are our wallet details. You give us yours. We then do a bit of testing. So we'll send you a few dollars. You send it back. We'll send you a few stable coins. You send them back. That verifies to us that you control the wallets and the bank accounts you claim to control. So it's a nice added verification that many banks still don't do, certainly on the wholesale level. You will then come to us and say, hey, Nick, I've got dollar stablecoins. I would like to buy dirhams. So can you please give me a quote? We will provide you with a quote. If you like the quote, we execute a trade. We could haggle a bit as well. Nick, I could do much better somewhere else. Come on. Take a couple of basis points off for friends. Anyway, so joking aside, we execute a trade. We then proceed to settlement. Various different ways to settle. So you could have pre-funded. You could have placed collateral. We could do something called delivery versus payment. You deliver your stable coins, we'll deliver cash, or we could do free of payment. That would be quite rare for delivering stable coins because it'd be so fast. You deliver stables and we'll deliver dirhams from our bank account to your bank account. We're done.
But in the case of Nigeria, because you don't have presence, I will need to ask my customer to onboard with the Yellow Card first, so they would be able to buy the. But let's say that the customers has already other provider and they already have a wallet of USDC or USDT. Then I would just need to provide you their address and my address. And the purpose of maybe providing their address as well, just for me as well, to do the screening, make sure that my customer is not making anything funny.
I mean, we could also be at both ends. So let's say, for example, you have your corporate treasury in France and you bank with SocGen. And then you have your corporate treasury, your regional treasury here in Dubai, and you bank with Standard Chartered. Okay, just make it up. So at the moment, SocGen and Standard Chartered are not the same bank. So you're having to SWIFT capital euros from SocGen, from your account in SocGen, and make it appear as dirhams in the UAE. You're having to do euro dollar. The dollars are going to the United States. You're coming around the world and you're doing dollar dirham and you're landing in the UAE. So instead, the French entity can buy stablecoins from us. So we'll KYC your French entity. We'll onboard it, execute a trade. They give us euros. We give them stablecoins. You can then send from your French entity to your Dubai entity the stablecoins. That's an intra-group transfer. We will then separately KYC your Dubai entity, and we'll buy the stablecoins back and we'll give it dirhams. So that's another different use case that you can use.
Okay. Any plans for Zodia to be actually present in those markets like Nigeria or other African?
Yeah, so we're young company. So commercially launched in September 2022. We got our license here in Abu Dhabi Global Markets in December 2024. Small team, so we're gradually going market by market by market, opening bank accounts, ideally with Standard Chartered. It's an absolutely fabulous bank. We know it very well. They're a big believer in what we're trying to do. Obviously, we're going to get to some jurisdictions. Brazil would be a good example. So Standard Chartered doesn't have banking capabilities in Brazil. Brazil is one of the most heavily adopted markets in terms of crypto in the world. So we're looking at a partner there, a joint venture, something like that, so that we can offer Brazil. So we're gradually trying to network up as much of the world as we can with our parent and then filling in the gaps. Africa it's a lot of countries, it's a lot of currency controls. But hopefully, I say this as someone who worked in Africa or in Nigeria for a year and has a huge affection for the place. One of the biggest things holding Africa back is the ability to make intra-African payments. It's absurd that, when I was living there, there are guys who will take a carload of cash from Nigeria to Ghana through Togo and Benin as a means of cross-border payment. That's just ridiculous. We need to get to, and so you'd have to do dollar Naira and dollar Ghanaian CD. The dollars would have to clear through the United States. So you have to go from Nigeria via the US to get to Ghana, which is bonkers considering you can drive there faster. So we need to get to a point, such as in Africa, where you can really dramatically increase African trade. And that's where one of the beauties of dollar stablecoins generally, particularly dollar stablecoins, is it's almost like a form of euro dollar. You don't have to clear through the US. It still ultimately ties back to the US. It's backed by US dollars. Even if they're in foreign banks, those banks will have US clearing banks. It'll be banked by US treasuries or money market funds. That'll all be in the US or ultimately be in the US. So the US is still going to, in my opinion, remain at the center of global commerce for a while, regardless of the headlines that are being bandied around for now. But it's going to be a change in infrastructure. And I hope that it's going to be a change that is going to emancipate a lot of people from the very antiquated system that we have now. And as I said right at the beginning, all it's going to do is it's going to bring finance onto the open internet. You should be able to send money like sending an email.
100%. You should be able to send money time efficiently, cost efficiently. And now, after our understanding, it's also fishy, free transfers.
Correct.
Right? Because you have full transparency as well.
And don't forget the psychology. We want to remove that anxiety. You're making payments. So that example you gave with that customer, and you're praying that it goes through. You click pay, go to the mosque. Please let it settle. Yeah, you shouldn't have to do that. You should press the button, and you should know maybe it'll take time, but you need to know how much time, and you need to have the transparency and go, okay, it's still on its way and it's going to arrive. And that just reduces that psychological anxiety.
100%. Listen, Nick, thank you. But before we go, I got you something. I don't know if you remember, but first time we met, you told me you're trying to learn. So you can open it. You're trying to learn Arabic.
I am, yes.
Yeah. And I told you the best thing is to use...
Look at that. My God.
So
Al-Quran.
Yes, this is the Quran.
In Roman script.
And yes, so you can actually read Arabic.
Wow, look at that. And in both... Okay, so...
English, Arabic, and Roman script.
And it's transliterated. So... Yes. وَلَقَدْ أَرَنَّهُ. Yeah, I'll have to improve the accent. You can train me on that as well.
You have to practice.
Absolutely beautiful, the binding. Thank you very much indeed.
Pleasure. And thank you
very much.
Thanks a lot. Thank you.
Pleasure. Shukran.
Thank you.